as I mentioned earlier, right, chapter 5 was all about how we purchase or obtain periodic inventory. Now, this is the chapter where we're going to learn how do we actually record sales when it comes to periodic inventory, okay? Of course, we talked about what the nature of the business is, right? Our main goal is to sell a product with intention to earn a profit, okay? We're trying to, originally we purchase goods, right? We buy the goods, and then we need to find some kind of way to sell a product, which includes the cost of goods sold and some kind of profit percentage, right? Because in all cases, right, you never want to break even. You always want to sell a product at a higher price because you want to try to, generate money. So in this case, what is going to be as a selling the product, right? We need to convert it into cash. So since we already took a look at how much it's going to cost us, right, by using the periodic inventory, right? If it's going to cost us the purchase price that we purchase it at plus the freight, right? That's going to be our cost of goods sold, right? So what we have to do is now, when we determine what our selling price is, that's where we're going to determine that we have to add some kind of profit percentage, whether it's 50% profit or 100% profit, right? We have to determine some kind of number that makes sense to us, that allows us to not only create some kind of selling price that covers my cost of goods sold, but the intentions of that is to also cover all of the expenses that it takes to operate the business. Okay? So then here, right, and we must charge sales tax, okay, because we're assuming that what our state is going to be one of the states that charges sales tax. And of course, we live in the state of Nevada. We are obligated to charge sales tax, all right? And in this case, to make it more easier for you to understand how tax works, tax is based on state and the local city that you are doing business in, okay? So the state charges a certain percentage, and then it depends on what city you belong in that tax on an additional tax. So for this class, I just want you to make sure you understand that we're going to make it sweet and easy and simple. We're only going to use 8.25%, okay? Because I think right now, tax is 8.375%, if I'm not mistaken. It has risen. I think it's going to rise up again, but that's okay. Just to keep it simple and easy, for this class, I want you to know that we're just going to use 8.25% for this class, okay? Because, again, taxes is based on the state that you're doing businesses as well as the local city that you are local city and county that you are providing a product to, okay? So in this case, the sales tax will vary, and I want to use 8.25%. Okay? Now, of course, when we talk about that, right, so we're going to be exposing you to what happens when we actually sell a product. Well, in this case, here's an example, right, where on June 1st, 10 items were sold at $9.99, okay, each. Okay, so in this case, and sales tax was 8.25%, record the sale. So in this case, right, I'm going to be introducing you to two accounts. Number one is sales, and the second one is sales tax payable, okay? So sales is a revenue, right? It's a means of us generating income, okay? And of course, sales tax, right? Sales tax is money that we must collect in place of the federal and state government, right? It's technically not our money. We don't generate it off of for part of our profits, but it's an obligation that we must charge for the duties for the state and the local aid, for the local city and everything, right? It's the responsibility that we must pay into for having a business, but also for selling a product. Okay. Now, of course, the other one I didn't talk about is the cash or the money that we receive, right? That's given, right? When you sell a product, what are you going to be giving in exchange? You're going to be given money, or you're going to be given placed it on an account, an IOU, etc., etc. But the main core here is that we have to understand that we have sales, which is an income account, and sales tax payable, which is a liability because we owe the money to the state and federal, right? We collect it and hold it until we make payments for our sales tax. Okay. So, of course, right, we take the number right here. We have $10 at $9.99. So that's pretty straightforward, right? So in this case, this is what we have to do. Since cash is going to be collected as a combination of the sales and the sales tax, right? So in this case, where the sales that we're looking for is what did we generate from the actual sale. In this case, I sold 10 items at $9.99, giving us $99.90. And of course, sales tax is going to be prorated, right? It's going to be based on the total amount of sales that you've encountered. So in this case, to figure it out, I'm going to take 8.25%. I'm going to multiply it by the total cash sales right here, which was $99.90, which gives us a total of $8.24. And then last but not least, you should be collecting a grand total of $108.14. Okay? So think of it in real life, right? When you're running the cash register and you charge for all the products, you scan them, and then you have a grand total, and then you have to press that tax button, right? And then you tell them your grand total is X amount of dollars, okay? Nobody is going to give you money for the products and then money for the sales tax separately. No, they're just going to give you like the whole thing in one go. But because we have to keep our responsibility, because again, since we have to charge tax, that means a portion of that money doesn't belong to us. It belongs to, it's our duty to collect it for the federal, state, it's not federal, the state and the city, right? That is, we must calculate it in our books that we have a separation between the money that we actually sold and the money that we're collecting for sales tax. So in our books, that's how we see it. Okay, so a portion of the money goes to sales and a portion of the money goes to sales tax. But the customer, right, who gives us the money doesn't know, doesn't care, and says, hey, here's what I owe you. Grand total. Boom. Okay. So in real life context, right, no one would give you, I'm going to give you this much for the sales and this much for the sales tax. No, they just give you a whole lump sum of money. All right. And that's exactly what we do. We record it as a lump sum money. However, we divide it into those accounts to reflect that we are making a separation between our sales and our sales tax. Okay. All right. Any questions here?
No.
All right. And that is it. That's how we record a sales. All right. So in this case, right, when we record a sales, we're recording an increase in cash flow, right? Whether we received cash or it was on an account, right? We increase our cash flow, so that's why it's debited. But we also increased our sales because we earned our revenue. So therefore, income is usually increased with a credit. And of course, sales tax payable, right? It's a liability, right? Because we owe this money to the government, we increase it because we had a sale. Okay? So, once again, under periodic inventory, we are not obligated to keep track of our sales in terms of countering it against our inventory. In this case, we don't care, because when do we actually know when do we actually calculate our total cost of goods sold, right? At the end of the given period, right? That's exactly what Chapter 5 was all about. Never was I ever informed that I sold this, I sold that. I was only given one key feature, and that is what was my total ending inventory. So someone went down to the basement, physically took account, and that's where the assumption is I must have sold all of the inventory, right? If I started out with this, but I end up having this at the end, I must have sold all of these inventories, okay? Of course, that's not the best way to keep track of your inventory, because what if someone went down there and took one for themselves, right? What if they took it home? What if your employee took it home? What if the owner decides to go in and take some for themselves, right? And we don't have proof. So again, it's not the best way of doing calculating your inventory for a business, but I mean, at the end of the day, you got rid of it, so it doesn't hurt you, because at the end of the day, you don't match your sales with your cost of goods sold, because at the end of the day, you're assuming that you got rid of all those inventory by selling it. Okay? So, of course, when we have our sales, right, we have to also assume that we have to follow the idea that customers may not like the product and want to return it. So we have to deal with sales returns and allowances, okay? Now, of course, right, our main goal is to sell a product to our customers and, generate revenue off of that, right? However, a customer can always feel the need to return the product to us because of many reasons, right? It's broken, it's damaged, it doesn't work. They're just completely unsatisfied with this product. Maybe it was a gift that they received and they don't actually like it, so they decide to return it, right, to get something else, right? There's many reasons that a customer is willing to return a product because of these reasons. So our job as a company is to restrain or restrict the, opportunity for customers to return their products, because our end goal is we're trying to make a profit. How can we retain a profit if a customer can just return at any given time? So this is where companies need to make some kind of return policy that limits the ability for a customer to return a product, right? And these policies could be, well, you can return the product within 7 days, 14 days, 15 days, or 30 days, right? For example, QVC, theirs is 90-day policy, right? 90 days. They want you to use the product. They want you to experience the product and give you 90 days to make your decision whether you like it or not. Okay, fair enough. So that means they offer money back guaranteed if you return the product within 90 days. Okay. But in this case, right, every company has their own store policy, right? If you don't want to have it returned within 30 days, you have the option again to restrict it by having a store credit, right? Or a final sale. You can only restrict it to having exchanges only, or even having an issued a credit or issue them a new product, okay? All right, these are all valid types of policies, because at the end of the day, once you sell a product, the goal is you want to keep those products sold. So these right here are going to limit your customers into returning the product even if they're unsatisfied, okay? Because you have a store company policy, right? It should be written on the receipt, whatever it is, so then the customer knows what the return policy is, right? And of course, if you do charge sales tax, right, you are 100% obligated to return sales tax back to the customer, okay? Which is straightforward, right? You just return the money and then calculate the tax on there and just give them their full money back, okay? Once again, sales tax is prorated, so that means you're going to have to go based on the price that they're trying to return, okay, the selling price that they're trying to return, and then you'll be able to calculate the sales tax on that, okay? So let's take a look at this example first. Of course, you have to have someone buy the product, so you have to record the sale first in order for you to be able to return a sale, okay? Now again, here we have on May 1st that you sold 50 coffee mugs for $5 each, okay? And of course, sales tax was 8.25%, all right? And of course, customer A pays with cash for the mugs, okay? So record this transaction, okay? So again, how do we record this sale?
Cash
Cash, good. What else?
and $250 sales
$250 sales, okay, good, correct.
and 200 the result of 250 multiply 8.25 division 100 divide 100. I don't know, I don't have calculate.
Oh, okay.
This is the tax, sales tax
Okay, good. So
and credit summit, sales and sales tax.
good, right? This is what we're gonna do, right? We're given that customer A paid us with cash, all right? And we recognize our sales and we recognize sales tax. So yes, that's correct, right? Sales is going to be whatever you sold the product for. So in this case, 50 times $5 is going to give you 250. Multiply it by 8.25%, okay, which is going to give you $20.63. So therefore, customer A is going to give you $270.63. Okay, good. So then, of course, when we come across this, right, we're on May 10, right? Customer A wants to return 10 of the coffee mugs for a full refund, okay? And of course, your company's return policy was a full refund within 15 days. So record this transaction. So in this case, right, I sold the product to them, to customer A on May 1st. My company store policy is that they could receive a full credit or cash back guaranteed if they return the product within 15 days. So in this case, it is fast forward 10 days later, it's May 10. So they meet the return policy date. Okay, so they're within terms. So in this case, right, we are obligated to give the money back. Now, how do we record this? Okay. So in this case, we need to calculate our amount that we're going to return back. So here, I'm going to be introducing to a contra account called sales returns and allowance. We must use a contra account for this one because all sales is actually final, okay? That's why if you ever go to a store and you attempt to return a product and they issue you the refund, right? Take a look at your receipt. you're going to notice that they charge you full price, and then right underneath it, they give you a line item that minuses out the product that you are returning. That's the same exact idea here. You need to create a separate account to reflect to reflect that you're trying to return a product. Or in this case, we're using a contra account to reduce the amount of sales. So in this case, the contra account is going to be called sales, returns, and allowance. So in this case, because a contra account flows in the opposite direction, right? Our original sales was credited. So if this is opposite, then we must debit the account accordingly. So, right, we have sales, returns, and allowances, okay? We also have to give the sales tax money back, right? That's what we talked about, right? Because we originally charged the sales tax of $20.63, right? So now we must give a portion of the sales tax money back. And of course, you're going to give the customer back their money or however they paid, right? Whether they agree, oh, can I have store credit instead? Okay, great. I want cash. Okay, there you go. All right. So in this case, right, this is where we have to start calculating. Well, again, we originally sold our mugs or our cups, right, at $5 each. So you're going to take the actual selling price of the actual mug. So in this case, they were $5 each. So 5 times 10 gives you $50, right? But we also have to calculate how much of the portion of tax we have to give back. So in this case, we're going to take $50 multiplied by the 8.25%, and you're going to have to refund $4.13. So in grand total, right, you're going to be giving back customer A $54.13. Okay? Any questions here? Okay. Now, let's go ahead and talk about a different scenario. What if that on May 15, the customer A, right, separate scenario, customer A wants to return 10 of those coffee mugs. Okay, they want to return because the customer actually doesn't like the color that they bought. Okay, maybe they bought it, they're like, oh, it's a nice color. Then they actually looked at it and was like, no, I don't like it. So then, of course, because it is the 18th, excuse me, I think I said 15. It's the 18th of May, right? They already passed the return policy, okay? But this customer is getting really mad and is demanding for a full refund, okay? Now, this is where small businesses can do this. They can, manipulate the actual selling price and offer additional discounts, okay? This is only for small businesses, right? Mom and pop shops, right? That are either cash basis or they just want to sell their inventory, right? So they can add additional, things to their policy. It's not like a corporation where it's strict, where you don't like your product, you return it. If you failed, then you can't get the money back. Okay? So in this case, right, we can haggle with our customer, or we can, because the main point here is that small businesses, right, they don't get as many customers, right, especially in their first couple years of doing business because no one really knows them, right? No one really trusts the brand, trusts the products that they sell. So in this case, right, we want to keep our customers as much as possible, okay? So in this case, right, we're going to say, well, I'm sorry, but what I can do is I can offer you a 15% discount, okay? In this case, right, this isn't giving a discount to any customer. This is because this customer is trying to return a product, but they've already passed the return policy and they're making commotion in your store, right? Because you want to keep, number one thing is the customer satisfied. So a way that you can, avoid conflict in your store is to just be like, okay, how about this? I give you a 50% discount because this time you don't like the product, but you know what? You can keep the product. And I'll be willing to give you a 15% discount, okay? Any kind of customer that gets kind of some kind of money back, they're more likely to just be, okay with that. So in this case, this is what's going to be called an allowance, right? Because we're not giving the full money back. We're only giving a portion of the money back. Just exactly how we do purchase returns and allowances, right? The vendor gives a portion of the money back. We can do the same thing too. We're not obligated to give a full refund. We can just give them a small portion of the money back. Okay? So in this case, we're going to be introducing, once again, sales returns and sales allowances function the same exact way, right? A return, you're returning the money completely 100%. An allowance, you're returning some of the money back. They eventually do the same thing because they're decreasing sales at the end of the day, right? Because in this case, right, the sales price, right, of $5 includes a profit. So in this case, when we're talking about this 15% discount, you're just discounting the selling price. That's it. So in this case, right, we would have to figure out what this number is to determine what the allowance is. Of course, we also have to give a portion of the money back for sales tax as well, because it's not based on the product that you sell, like not the items quantity-wise. It's based on the total sale price, okay? And of course, you're going to give back the money however they paid, okay? So let's go ahead and figure this number out. This person is trying to attempt to return 10 of those coffee mugs, right? So in this case, we charge $5 as usual, right? So in this case, if it's 5 times 10, that's $50. But we're not giving all of the money back. We're only going to give them 15% back. So in this case, 15% of $50 is going to be $7.50, okay? And from there, right, we're only refunding $7.50. So therefore, I need to also give back the tax because it's based on the actual price, how much generated revenue that you actually created or sold, right? So in this case, if I am refunding $7.50, therefore I have to refund the tax off of the $7.50 instead of the whole entire amount. Okay, so in this case, right, 8.25% of 750 is going to be 62 cents. So therefore, you're going to be giving customer A back $8.12. Okay. Of course, in real life, you don't have to actually do the calculation yourself. You just press the button on the cash register and it will do everything for you. However, when you're journalizing, you need to make a separation. Okay. In this case, because if you are the bookkeeper and the accountant, are you going to be the one that's going to be at the cash register? Probably not. However, your duty is to look at your source document, so with your receipt, and it will tell you the exact amount, so you don't actually have to really calculate it, okay? But in this case, since I don't have the receipt, I have to calculate it manually, okay? All right. Any questions here about sales returns and allowances?
No.
Okay. So, of course, when we sell a product, a great way to entice our customers to come into the store and buy our product is to have a sales discount, okay? So, of course, it's some kind of way to market yourself, but also to give you some promotion, right? Or, yes, some promo, some way to get your name out there, right? Because, again, we also have to think about what is the customer willing to spend? Now, again, customers, depending on what kind of customer they are, whether they look into doing research into the product that they're purchasing, or whether they are, on a budget, right? We also have to understand that a customer is not really willing to buy something that's full price. They'd rather buy something that's on sale, right? Because then they can buy more for their dollar, right? They can spend more and receive more products out of it, right? So sales is a great way to, again, entice your customers to want to come to your store and buy your products. And if an item is on sale, you are 100% more likely to sell out your products a lot more quickly than if you were to leave it at regular price. Okay, so think of a grocery store, right? Would you buy coffee at full price, or would you rather buy it on sale? Okay, if you buy it on sale, right, you can get more for your money, right? You can get twice as much, or even, you can get two of them for the price of one, right? Depending on what the sale promotion is, right? And again, it could be for, grand openings, right? Weekly news ads, for any reason that you just have a sale. It could be an online deal, okay? So again, it's just a way to promote the store and the products that it sells, and it kind of markets it and tailors to your customers so they can get notified, so they could either come down and buy your product, okay? Now, here's again a notion that you need to know, right? A sales discount does not take off the price of the actual cost of the product. It takes it off of the actual profit. Okay, so again, we talked about cost of goods sold, and then we talked about the portion of the money is going to be the profit percentage, right? Money that you're intentionally trying to earn, right? Now, of course, rule of thumb here is when you do have a sales discount, you never want to have the discount to the point where it affects the total cost of the selling price, and it dips into the cost of goods sold, right? You never want to break even. You want to try to make sure that you get some kind of profit, because then at the end of the day, if you're constantly having sales on your products and it is bringing to the point where when you sell a product and it's at the cost of what it took you to purchase the product, you're never going to gain a profit, right? And that's why most grocery stores, if you did not know, they barely make a profit. Their profit margins are about maybe 3 to 6%. Why? Because they sell groceries, right? Groceries is one of the most wasteful type of inventory you can sell, because if you don't sell the goods, they get rotten, right? The produce gets bad, and they're forced to dump it out. So they're forced to take losses every single day, okay? So that's the same idea here. You never want to sell a price, but also you don't want to discount the price to the point where you're not making a profit. Okay, but the idea here is a sales discount is basically you're discounting the sales price, where you're not hurting yourself. You're just taking a discount off the profit. Okay, and of course, there are two different types of discounts that you could take a look at. One is a store-wide discount, and the other one is when you have customers that place on an account, and what you can do is you can offer them additional discounts on top of that to kind of entice, to initiate them to kind of pay you back. And we'll talk about both of them in the next couple slides. So we talk about in-store sales. Okay, this one's the most common one. So in this case, right, in-store sales, an in-store sales discount means that any customer that comes into your store, they are eligible to get the discount. Okay, so this discount, right, we talked about, it's different than the one when you return a product and the owner decides to give the customer a special discount, right? That's on a per case situation, right? The customer's trying to return a product. In this case, right, this is an in-store sales, so therefore anybody that comes into the store, whether it's any kind of customer, right? Doesn't matter if they're putting it on an account or not, they are going to be receiving this sales discount because this one is applied to anybody. Okay? So this is going to be, we're going to be using the account called sales discount. Okay? Straightforward. So in this case, right, sales discount is also another contra account because it reduces the amount of sales that you would normally receive, right? So in this case, let's take a look at this example here for scenario 1, where we have an example where on June 1st, your store is having a promotion on all items are 40% off. If a customer buys 10 baseball hats, which the original price of it is being sold at $10 each, right? And then of course the sales tax is 8.25%, record this transaction. So in this case, right, there's a few things that you need to know, right? First off, right, this is a sales, but we have to also include the sales discount, okay? So in this aspect, right, if customer A decides to pay with cash, right, that's your first thing that you're going to recognize. You're going to recognize that cash is there, okay? But the idea here is that, of course, you're selling a product. You should be receiving something, right? You're going to record the discount, okay? Because in this case, we have to calculate it. Of course, you're going to charge your sales as regular, right? Because that's how you figure out what the discount is. And of course, you're going to get taxed off of the discounted price, okay? So here's what it should look like, right? Now, this is very similar to when you go to the store too and you buy something that's on sale, right? You're always going to see that they charged you at full price and then they have a separate line item to record the discount, right? You'll see the full price of $9.99 and then right underneath it, you'll see minus $4.89, right? That's their discount. And then you get your total amount and then you get your tax and then you're going to get the cash that you paid, okay? So in this case, right, you are not able to take a discount off of sales tax, okay? You can't discount sales tax. You can't discount shipping, handling. You can't discount anything except for the product, okay? So let's figure these numbers out, okay? If I sold 10 baseball hats, right, and the original price was $10 each, that is $100, right? $100. That's what your original selling price is, and that's your original sales. Now, in this case, my discount amount is 40% off, right? So this is where I have to calculate how much is my discount going to be. Well, 40% discount, that's going to be 100 times 40%, which gives you $40. So therefore, my discount is going to be $40, okay? Now, of course, my assumption here is that if I'm taking a discount, therefore, I should be receiving less cash, right? That's the idea there. But I have to charge sales tax. Now, in this case, right, you cannot charge sales tax for the full original price. You can only charge on what the customer is going to leave the store with. So in this case, right, we must calculate tax off the discounted price. So in this case, 100, right, is my original sales minus 40, which gives you the total selling price of $60. That is what the customer is going to walk out the store with. So therefore, I need to calculate my tax off of $60. Okay, so in this case, 60 times the 8.25%, then you're going to get a total of $4.95 each. So therefore, the total amount of cash that the customer must give you is $64.95. Okay? All right. Any questions here?
No.
Teacher,
Yes.
in the discount policy, you said many items, but you don't add the discount from when customer want to return, like the example before, discount for return is 15%. This discount and this sell discount, but that is a returns discount.
Correct.
Please explain more.
Okay, this sales discount here is for anybody. Anybody that walks into your store, they're going to get this discount. So any customer that wants to buy a product and you have a store discount, you would use sales discount. Now, in the previous example, because that was a per case basis, right? Where a customer is complaining and doesn't like the product and you're trying to convince them, well, you missed the discount period. You missed the return policy. But what I can do is I can offer you a 15% discount. That is separate because can everybody get that 15% discount?
No.
No, it's just only that one individual because that one individual is complaining. And you want to try to keep their company as a, means of a business, right? You're looking forward for your company because they're the only ones that are buying your product. So you want to keep them satisfied. So in order to do that, you add an additional offer of a 15% discount. But that right there, you're not giving them their full money back. You're giving them a portion of the money back. So that's why that's considered an allowance. In this case, right, we're not talking about returns and allowances. We're talking about a full-on discount, okay, where you're offering to everybody. So in this case, that's the difference between this discount and a sales returns and allowance discount, right? It's based on the per individual basis, right? In this case right here, anybody can get the discount. So we treat it as a discount. The other one was because it's individual basis. So because they tried to attempt to return it, I told them keep the product and I will give you a discount off of that. Okay? So in this case, this person isn't returning anything. They're not getting a discount because they're returning a product. They're getting a discount because it's a store-wide sale.
Thank you, teacher.
Okay. So, of course, when we talk about sales discount, let's go ahead and put in context. So the first one was in-store, right? This one's straightforward when we're in the store. But let's talk about what other opportunities that you can offer discounts to. So if you guys remember terms, right, when we offer it to our customers based on a criteria, right, if they decide to place this on an account, right, you can offer terms to a customer, right? Just like how vendors are able to also give us terms as well. That is a way to basically encourage your customers to pay you back on time, okay? So again, terms is a condition, right? Terms, you must meet a condition in order to get a discount, right? And of course with terms, right, for this example here, our terms is going to be 5%, 15 net 30. That means we will discount 5% if this customer pays me within 15 days. If not, they have to pay me in full within 30. So I tacked on a term. So the condition must be met in order for this customer to receive a discount. Now in this case, right, because this is offered to anybody that is going to be using their account. So in this case, right, any customer that is willing or is going to be purchasing their items on an account, then you have the right to give each and every single customer terms. So in this case, this isn't a special case per BESA, right? This one is because they are choosing to place orders on an account versus just paying it right there in store, all right? So then you could offer them an additional discount if they kind of give you your money back quicker. So again, that's it's an incentive for customers to pay on time, okay? Because if you can get your money back a lot quicker, right, then you offer them a generous discount, okay? So in this case, right, this example here on July 1st, a customer wants to buy in bulk, okay? They want to buy 100 baseball hats, okay? Which again, the store sells them at $10 each, remember? And this person wants to buy it on an account, okay? And because the customer is a first-time buyer, you offer them terms, okay, which are 5% 15, net 30. So again, it's a new customer. They want to buy it on an account. Great. You're going to buy it on an account. I will give you terms because you're a first time. You're opening the account for the first time. So you're going to offer this to them, okay? Each hat, once again, was sold for $10 each. Sales tax is 8.25%, and delivery charges were $10, okay? So record this transaction. So maybe you're like, you're going to buy 100 hats from me. How about I deliver it directly to you? It's going to cost you $10, okay? And, of course, you're going to charge sales tax and et cetera, okay? So in this case, we're going to record the sales exactly the way it should be, right? Because in this case, terms is a condition. The customer must pay in order for them to receive the discount. So in this case, right, our notion or our assumption here is that they're going to owe me for the full amount, okay? So let's talk about what those price points are. So again, we're going to have your accounts receivable because they're paying on an account, right? They're receiving the 100 hats at $10 each, okay, which is $1,000. You're going to charge sales tax on top of that, right, which is going to be 8.25%, which gives you $82.50. And then you're going to tack on the delivery charge at the end, okay? Delivery charges, freight charges can never be taxed, okay? So therefore, it's always going to be added at the very end, okay? Sales tax can only be on the product that you sell, okay? So this is exactly how we have it here. So that, therefore, this customer owes me a grand total of $1092.50, right? We got $1,000 for the actual sale of the hats. We got the tax of $82.50, and then we tacked on an additional charge of $10. Okay. So then, fast forward, it's July 12th, and again, the customer decides to pay for his amount that he owes, right, in full. So in this case, right, he meets the terms, right, because when we sold the product to him, it was on July 1st. His terms are 5% 15, net 30. So in this case, he meets the discount period, right, because he paid within 15 days. So in this case, how do I record the discount now? So this is what you're going to do. You're going to, number one, record that you received the cash, right? But of course, it's not going to be for the full amount, okay? Because you need to recognize that because this customer paid within terms, you need to calculate what the discount amount is. And because you charged tax in the first place, you also have to give a portion of the money of the tax back because in the original one, you already charged them the sales tax. In this case, if they're getting a discount off of the sales, you need to adjust that accordingly so then you get the proper amount of tax to charge for the actual sale. So in this case, you need to give back a portion of the money back. And last but not least, you have to also record that they don't owe you money anymore, okay? So rule of thumb here is you're going to start with your accounts receivable because at the end of the day, the original amount that they owed you was $1092.50, right? That's your starting point. At least you know they owe you $1092.50, right? However, now, of course, we know that for a fact, if we go back to that transaction, right, we have 3 accounts that were affected, right? We had the actual sales, the sales tax, and the delivery charges. In this case, you can only discount the original sales price. You can't discount tax and you can't discount delivery charges, right? So in this case, then we have to dissect the actual original sales to find how much the actual invoice was for, right? So in this case, we recognize that the customer purchased 100 hats at $10 each. So the only number that we can discount is going to be the $1,000, okay? So the $1,000, right? In this case, because they received a 5% discount, 5% of $1,000 is $50. So that is where you're going to pop that into your sales discount. That means they're going to give you $50 less, okay? But we also have to calculate the tax off of the amount that you're being discounted for. So in this case, I'm taking out my discount for $50. So therefore, I need to take out 8.25% off of the $50 I'm taking off. So in this case, that's $4.13. Okay, so therefore, I'm subtracting $54.13 away from what I actually originally owe. Okay, so then that's going to give me a grand total of $1038.37. Okay, and that's what the customer owes me. All right, any questions here?
No.
So course review, once again, we got to take a look at how to record a sale, what happens when there's a sales returns, okay? And of course, we talked about the difference between recording a sales discount when it's in store, as well as versus whether you give them terms or not, okay? So again, in-store sales, you're getting the money right then and there. So therefore, you're going to calculate the discount right then and there. Whereas when you're giving terms, your initial thought is that you have to meet the terms. If you don't, or a payment must happen in order for you to calculate the discount. If it doesn't, then therefore, they just owe you for what they owe you. Okay? All right. All right, so let's go ahead and take a look at our exercises here. Okay, so here is the chapter 6.1, 2, and 3 exercises, okay? So here you go, journalize and assume that sales tax is 8.25%, okay? So let's take a look here. On April 5th, you sold 100 cups at $5 each to customer A for cash. Okay. So how do I journalize this? on April 5th?
اسكت يا cash.
Yes, we received cash.
Yes.
Okay.
500 plus tax.
Okay. Okay, what else do you need to recognize?
Credit side sales and sales tax.
Good, right? Credit side, you got sales and sales tax. Good. Right? So in this case, how much is my total sales?
500.
500. How much is my tax off of this?
I don't know. It's difficult.
Okay.
With a sales tax payable of 41.25.
41.25. So in this case, how much cash should I be receiving?
541.25.
Good, right? And of course, you should make a note here that you sold X amount of items, right? So in this case, I sold 100 cups to customer A. Or, I mean, no, in this case, sure, to customer A. Okay? All right. So then, Maggie, can you mute your microphone? You have a lot of background noise. All right, so on April 7, okay, you sold 25 cups at $5 each, okay, to customer B on an account. Terms are 10%, 15, net 30.
Account, you're gonna use accounts, account receivable, sales tax.
Okay, good. So in this case, if I sold 25 cups at $5 each, what's my total sales?
125.
What's my tax on that?
$10.31.
I think it's 32 because it's going to be 1.5. 315.
Yeah.
Okay, so it would be 32. Okay. Anybody else want to double confirm that?
One 32.
Yep. It's 3125. Oh, it's 3125. So in this case it'd be 31.
It would be 3-1.
Okay, I'm sorry?
Nothing. I was repeating what you just said. Sorry.
I can't really hear you. Can you repeat that again?
So I was just repeating what you said. It was 10, and then it's 31.25. So 10.31.
Yeah, I see it. Yeah. Correct. So in this case, remember, when it comes to sales tax, you must round up. Okay. So in this case, what's my total amount that customer B owes me?
35, 31.
Good. Okay, so again, sold 25 cups
Customer B.
to customer B. Okay, of course, you also want to put in the terms. Terms is going to be 10%, 15, net 30. Okay. All right, so that was April 7. I don't know why I put April 10. Okay. So then on April 10, you end up selling 50 cups for $5 each to customer C for cash. Okay. So in this case, I sold 50 cups to customer C for cash. So how should I record this?
Yes. Cash sales tax payable.
Good, right? Cash, sales tax payable. Okay, so in this case, what was my total amount of sales? If I sold 50 for $5 each, how much is my total sales?
150.
250. Good. How much is my tax?
Is it just double the top one? 226.
20, 60.
It ends with 5, so would it be
ما قلت الشريط.
Point. Okay. Yeah, it ends with 5. So in this case, you have to round up. So it'd be 63. So in this case, how much is my total amount of cash I should be receiving?
270.63.
270.63. Okay. And once again, you're going to make a note here. Sold 50 cups to customer C. Okay. So then on April 15, customer A returns 10 cups for a full refund. So customer A. So let's see. What did customer A do? Well, here customer A bought a total of 100 cups. And now this customer A wants to return 10 of them for a full price. So how should I record this?
Sales return and allowances.
Sales, returns, and allowances. Good.
Sales tax. Sales tax.
Sales tax. Good.
Retail. Yes. Payable. This is cash.
And we're giving them cash because that's what they originally paid me with, right? So in this case, if I'm returning 10 of those cups, how much did I originally charge each cup?
$5 for each cup.
$5 for each cup. So if customer A is returning 10 of them, how much is the sales, returns, and allowance?
50.
50, right? So in this case, $50 is going to be refunded to them. But however, we also have to give them a portion of the sales tax money back. So in this case, because that's what we originally charged them in the first place, so we have to give back their money. So in this case, how much is the sales tax?
$4.13.
425.
For, yes, 413. Okay, so in this case, we need to give them $54.13 back. Okay, and we're going to make a note here too that customer A returned 10 cups for full refund. Okay, good. So then on April 20th, customer C, okay, decides to return 25 cups return 25 cups, but is willing to accept a 15% discount. Okay? So here customer C is trying to return the mugs, okay? Maybe he missed the company policy, so now we offer him an additional 15% discount. So in this case, right, he's attempting to return 25 cups, but is willing to accept a 15% discount. So in this case, if I sold each cup at $5, right, how should my journal look like?
Will it still say returns and allowance?
Sales, returns, and allowance. Good. And of course, how did customer C pay me?
In cash.
They paid you back in cash, so therefore, you must give the money back in cash. Now in this case, am I giving a full refund? No, I'm only giving a 15% discount. So how much is my discount for?
1875.
125 multiply 15%.
Which gives you 1875. Good. $18.75. Now in this case, because I have to give a portion of the money back, what is the sales tax off of the $18.75?
$1.55.
$1.55. So therefore, how much cash am I giving back to customer B?
$20.30.
$20.30. Okay, good. All right, and then I'm also going to make a note here that customer C return or refunded 25 cups for 15% discount. Okay. Last but not least, we have April 22nd. Okay, customer B decides to pay for his purchase and made the discount period. Okay. So in this case, right, let's take a look at customer B. What did customer B buy from me?
A 100 cups
That's
at $5 each.
That's customer A. Customer B
25.
purchased 25 cups. Good. Now in this case, let's take a look at what customer B actually owes me. So in this case, accounts receivable, customer B owes me $135.31. Okay. Now, of course, the total sales here was $125, right? And of course, the sales tax is 10.31%, or $10.31. So in this case, customer B is paying off the entire amount. And because we offered customer B a 10% discount if they paid within 15 days, so we purchased it on the 7th, and fast forward 20 day 20 on the April 22nd, which is exactly 15 days. Yes, it's exactly 15 days. So therefore, we must give customer B the discount. So how am I supposed to record this? Okay.
Sales discount.
Sales discount, okay. Maggie, can you every time when you speak, can you mute your microphone immediately? You have a lot of background noise. Okay, so sales discount.
And would it be checking an account receivable?
Checking, okay. In terms, yes, you would normally receive a check if they owe you money, but they could also come to the store and pay you in cash as well too. So in this case, whatever way that they paid you, right, whether it's cash or checking, they send you a check, it doesn't matter. At this point, you're receiving money at the end of the day, right? And accounts receivable is going to be the last thing that you are going to put in here because they don't owe you money anymore, right? They are paying off the debt that they owe you, okay? Now, in this case, right, accounts receivable, how much do they actually owe me?
135.31.
135.31, okay? That's how much they owe me. Now, in this case, right, that's what they owe me. I'm obviously going to get less money because I'm discounting the product, right? So in this case, right, what did I originally charge them for the total amount of sales for this? What was the original amount of sales? Go ahead.
125.
I originally charged them $125, but because they received a 10% discount, how much is that discount going to be?
12.5.
$12.50. Now in this case, because here's one thing. I also charged them sales tax the day that I recorded the sales. So in this case, because they're going to be receiving a discount, I also have to return to them their sales tax money because I originally charged them in the first place. So now I need to give them back the money. So how much am I going to give back off of $12.50?
$0.65 or $0.9.
$1.03.
Okay, it's going to be what was that?
I thought it was $1.03.
$1.03. Okay, because it's was it 10.31? So in this case, it's going to be $1.03. So therefore, right, what's the grand total amount that I am going to be receiving from customer B?
111.47.
111.47. Okay, check the math on that. 111.47. Okay, 135.31 minus $12.50
112.
minus 103.
112.
What's 112? The amount is 112?
The cash check in
It's not 112. It's not 111.
122.
122 is a rough estimate. $121.78. All right. So let's take a look at this, okay? So you're going to take the 135.31. You're going to subtract the discount, which is $12.50. You're going to subtract the tax of $1.03, and you should be remaining with 121.78. Okay.
Oh, I see. So I just subtracted the 125, not the 125.
Correct.
Sales tax.
Correct. 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 Okay. So there you go. Because this is the total amount, right? Because that's what they originally charged me, right? Or I'm sorry, this is what we originally charged the customer, right? That which includes the actual sales price and the amount of tax. So in this case, I'm just taking out the discount and taking out the tax I'm supposed to refund them, and that's the total amount that I should get, including the sales tax that should be the accurate amount. Okay? And of course, I'm going to go ahead and say received payment from customer B, and then 10% discount. Okay. Good. Any questions in regards to journalizing sales returns, and sales discounts?
No.
No.
Okay. All right. So I'm going to go ahead and call break now. So right now it is